Renewed military strikes involving the U.S. and Iran have once again raised concerns over energy supplies moving through the Strait of Hormuz. Commercial vessel traffic has fallen sharply, shipping costs are rising, and geopolitical risk has returned to the oil market. But while the focus has been on crude oil, another question is starting to emerge. Could these latest developments tighten refined fuel markets even further? And which parts of the world are most exposed? I'm Johanna Bota, and joining me today is Alex Hodes, Director of Energy Market Strategy at StoneX. Alex, welcome back. Can't believe we're here again. Just when it looked like tensions were easing, renewed attacks have sent a risk premium back into oil prices. From a fundamentals perspective, how significant are these latest developments?
Yeah, it seems we're basically right where we started
Hmm.
several weeks ago before the signing of the MOU. So I believe we will see more disruptions ahead. So Strait of Hormuz crossings have slowed down. And why this kind of is taking the market by surprise was that the crude oil market was essentially pricing in perfection that we were going to proceed with no issues.
Mm-hmm.
The market was pricing in sub $70 crude in WTI, and we were seeing vessel crossings almost surpassing on certain days, surpassing pre-war levels.
Right.
So right now we're kind of back to where we were. However, there are still some kind of buffers in place that we're going to see if this is prolonged. So we could see some more demand destruction once again. But really, right now, we're kind of trying to digest whether this is something that's going to be a lasting issue or if we're going to come back to some semblance of peace here soon.
And that's really hard to do. If shipping activity through the Strait of Hormuz remains subdued, where are the biggest risks to physical supply? Is it crude oil, refined products, or LNG that concern you the most?
So I would say one factor that has been tighter than crude oil, LNG, just in general, has been diesel specifically.
Hmm.
So the refined products market had been hit prior to this scenario
Yeah.
in the fact that the supplies were very tight heading into this. And then refineries have been attacked. And then, in addition to that, there have been attacks on Russian refineries by Ukrainian drones, and that's really tightened the market as well.
Yeah.
Russia banned diesel exports. So even if the strait were flowing as we had seen several weeks ago or just last week, even, there would have been tightness in diesel in the first place.
Mm.
And we're really seeing diesel take off even more so than we are on crude oil. And we are seeing crack spreads into the $85 per barrel range
Yeah.
in WTI and heating oil. And that is way beyond seasonal averages. It's close to historical highs. And that's signaling that we are very tight on diesel supplies with respect to crude oil. So that's not to say the other products are not of concern. However, that seems like the most constrained product at the current moment.
And you and I have talked a lot about inventories over this past few months. How much of a buffer does the market have if we see another supply disruptions when it comes to inventories?
I will say that one of the biggest buffers we have is probably one of the least visible areas, and that's coming out of China. So there are kind of estimations on how much there of supply there really is with regards to inventories. However, that's kind of just something we don't truly know. But in my opinion, and some of the signs that we had seen previously, they had assessed that they almost had 100 days worth of inventory still left
Mm.
when we had seen the signing of the MOU. So I would imagine that they're still going to, if prices get back higher, they're going to kind of step away from the market and start drawing down on inventories. And I think we saw at the peak in May them reducing over 4 to 5 million barrels per day
Yes.
of crude oil inventories.
Hmm.
So that's a substantial buffer right there. We are running into more constraints on from the US's side of things. So the US has still been drawing down on the SPR.
Hmm.
We have a lot lower of a buffer than we had prior to the conflict there. So we're going to see probably some constraints in the US as well. So you could probably see the SPR, we're going to draw down a little bit more, but with regards to that tightening of inventories, we're going to have to see WTI crude oil prices move significantly higher to kind of keep some of those barrels at home. But we are in very tight supplies on gasoline and diesel in particular. And that's why you're seeing those prices kind of shoot up a little bit faster than we are on crude oil.
I see. Now, this next question is something that I've asked you before, and it's more a reminder because we've been here before. So, which regions are most exposed if disruption in the Gulf persists?
So Asia is the primary region that
Hmm.
is susceptible to the Middle East. So they have been kind of the first area that that you saw kind of
Yeah.
shortages in jet fuel in particular. Some of those have been alleviated. However, we're about to head into the fall,
Mhm.
and then a lot of these times prior to the winter, Asian buyers like to secure some of their heating fuels. So
Hmm.
that could be either diesel fuel or heating oil, propane, stuff like that ahead of the winter.
Yeah.
So I'm going to imagine that that's where you're going to see some of this tightness or some of the rushing back in of these buyers on those types of fuels.
Hmm.
And that's going to be an area, again, where we're seeing kind of the tightness displayed first off. And then you're going to see it kind of progress in Europe as well.
Yeah.
Has also the exposure of Russian diesel as well. And then, then the US as an exporter is going to see these elevated prices. They might not be as constrained from a pure supply standpoint,
Hmm.
but you're going to see those prices eventually tick higher as there's more exports driven from the US as well.
Understood. Alex, thank you again for joining us and keeping us up to date because it's very hard to do so right now. And thank you to our viewers for watching. For more financial content, don't forget to like and subscribe to our channel.